All right, folks, welcome to Lesson 8 of CU Technical Paradise. Now, before we begin with the details of the charts, we have to really focus in on understanding this picture. In this picture, on the left side, you have smart money, the liquidity provider. And on the right side, you have speculative, uninformed money. This is everyone. So on the right side, in the big circle, you have us, you guys, retail traders. You have the banks, you have the institutions, you have the hedge funds, etc. That is dumb money. Smart money is the market makers, and it is a small group of families that control and own and play with the markets however they like. That's the landscape, and that's how the markets work. That's how they've worked for a long, long time. All right. Now, before placing any trade, you have to have this in your mind. The market makers are the driving force behind every large price leg. Always have them in mind before any trade you place. I'm not allowed to go into too much detail about who the market makers are, right? But I will tell you that there definitely is a market-making entity, and they control all the markets around the world, whether it's crypto, whether it's Forex and futures and whatever. They control all the markets around the world. It's a very small group of people. And us as retail traders, we are nothing but we're like fleas on the dog's back going for a ride, right? Like a ship in the middle of the sea, controlled by the waves, right? Like a tree leaf in the autumn air. And this is something you have to deeply internalize, which is understanding there's market makers who control the markets, and then we're going to try and I'll show you how to find and look for cues that they give as signals for entries, or as signals that a large price move is going to happen. And that's basically turtle soup. Right, and that's all I will say about this topic. Don't text me asking me to explain more. Don't email me. This is the last time. I've said too much, but I won't be going any further in this topic. Perhaps in the in-person events and the book, but as far as CU is concerned, this is all I will say about the market makers. Right. Now, the chart you see in front of you, you have marked on the left side a swing high, and then you have a swing low down there, and you have another line there, up, right. But before we go into the details, we have to understand that every single candle you see in front of you, what's a candle? What is a candle? A candle is data. A candle is data of either a lot of buying going on or a lot of selling, right? We use candles to derive and try and predict the directions of the next candles That's what we're doing. Yes, we are predicting, not reacting. Right? So anyone who says you're reacting, even when you're reacting, you are predicting that there will be a reaction. Right? So we use these candles, this data you see in front of you, to predict price moves. And I know so far this has been a mouthful and a brainful for most of you. So feel free to pause and rewatch to try and catch the stuff you missed. And of course, always watch with a notebook in hand, right? Excuse me. Now we're going to quantify the actions of the market makers, and I have created a certain language which I'll teach you in depth and see you. But let's start with the basics. First of all, we have the open, high, low, and close. Right? Very basic. It's the way candles are formed. An up-close candle on the left side is formed by an open, low, high, and close. And a down-close candle is formed by the open, high, low, and close. Right? And on a bar chart, this is a little trivia. On a bar chart, is the open the left side or the right side? That's a little self-corrected homework for you to answer. Right, the open, high, low, and close is one of the two main concepts we trade based on as CRT and turtle soup traders, right? Open, high, low, and close. The shape of the higher time frame candle. You want to try and guess it just by looking at the outer shape of the candle, right? We are candle traders. What does that mean? That means we're trying to trade certain candles, whether that's a weekly candle, whether it's a daily candle, whether it's a monthly candle, 4-hour candle, 1-hour candle. It's unadvisable to go below that, right? But you're trying to go and look at a candle. Now, if this candle, as you can see on the left side, that's a CRT candle right there, the candle can either be turtle souped, right? So candle 1, the thick down close candle, turtle soup, and then it goes higher. Or it can be a close below CRT, which then goes lower or higher, right? So it's either going to turtle soup, as you can see on the left side, or it's going to stay within the candle, or it's going to close out of the candle's range, right? These are the only possible 3 outcomes of any candle at all, right? Once again, let that sink in. Whichever candle you're trying to trade, whether it's the weekly candle, daily candle, the monthly candle, whatever, the next candle you are trying to trade only has one of these 3 outcomes. Either a wick above or below, either it keeps trading inside, more consolidation, or it escapes the range and closes out of the range. Right? And I want you all to become, as much as possible, experts at narrowing things down and reaching a very narrow set of conclusions, because as the saying goes, in the eyes of an amateur, there are many possibilities. But in the eyes of an expert, there are few, right? CRT terminology. Now I'm just going to read this out for you over here. Excuse me. CRT stands for candle range theory. CRTH is CRT high. And these are all markings you'll see on my charts and on the charts of the CRT students. CRTL is CRT low. Minus target is a bearish target. Plus target is a bullish target. Minus kiss of death turtle soup is a bearish kiss of death turtle soup. Plus KODTS is bullish kiss of death turtle soup. Breaker, FVG, rejection block, and we'll see examples of all of these, obviously, in the upcoming lectures and in the FAQs. Minus FS, failure swing, bearish. Plus FS, bullish failure swing. Turtle soup, fake market structure shift, fake bullish and bearish market structure shift, weekly opening price, daily opening price, pre-open liquidity pool, weekly opening time, closing time, daily opening time, and closing time, model number 1, bullish and bearish, retrade to model number 1, which is either an OTE or a direct trade right after the model 1 is created. And we'll see all of these. There's a special chapter on entry models. 50% is halfway point of the price range. GCT is the golden candle time. This is one of the best times to day trade. From around 8:15 a.m. all the way up to 1 p.m. Right. 9 a.m. is also fine. But I like to go and start hunting from 8:15 a.m. Kill zones are basically the hunting time, right? New York time, which is all the kill zones are based on New York time. The Asian kill zone is from 8 p.m. New York time, all the way up to midnight New York time. The London kill zone is from 1 a.m. to 5 a.m. The New York kill zone, is from 8:15 a.m. all the way up to 2 p.m. all in New York time, right? And there's an important distinction to be made between the kill zones and the candle opening and closing times. These are the best times to day trade. And more often than not, these are also the best times, and you better be noting this, these are the best times at which long-term swing points form also. Right? Now, should you be a swing trader or should you be a scalper? And the answer is none. It doesn't matter, because a candle is a candle. What you see in front of you can either be, it can be a 4-hour candle, right? It can be 2 4-hour candles beside each other. It can be a daily candle. It can be 2 weekly candles. It can be 2 monthly candles. So the idea of scalping and swing trading and whatever is outdated. It is now officially replaced. I replace it with candle trading. Right, so when the group chat opens, then I don't want to see anyone talking about swing trading or scalping or whatever. And if they do, they must mean candle trading, right? So I'm trading the daily candle. I'm trading the weekly candle. I'm trading the 4-hour candle. And if you're going to use the term swing and scalp and whatever, then use it strictly having the candles in mind, right? Now, one of the most important concepts is the pre-open liquidity pool, PLP. This is something I have not spoken about publicly or privately before, at least not explicitly. Right? I have mentioned it in my private, in the private one-to-one group previously, in the past, right? But here you have it. The pre-open liquidity pool is a swing high or low that happened before the opening price. It is expected to mark the high or low of the next candle. It is one of the most crucial factors to the hunting stages. And the hunting stages are as follows. As you can see, you have in the vertical lines the opening time, 1, 2, 3, 4, and then look at the relationship between price when it attacks the pre-opening time liquidity pool, turtle soup. Start all the way from the left. Right, you see those two red dots? Those are pre-open liquidity pools being stabbed into, then reversed. Right, and again, pre-open liquidity pools. All of those, every single red dot is a pre-open liquidity pool. You can even, these are weekly candles. You can dissect them even further into an infinite loop of pre-open liquidity pools being turtle souped and then traded away from. Right? So again, in very simple terms, the pre-open liquidity pool is a part of the sequence of opening time. So the candle opens, it stabs, and I want you to imagine as I'm explaining this, I want you to imagine in your mind how it plays out. The candle opens, it wiggles around a little bit, then it goes and it stabs into a pre-open liquidity pool, and then it rallies away. Upwards, for example, as you can see right here. Look at the third box. You can see price opens. It stabs down into the pre-open liquidity pool all the way to the left, and then it rallies violently upwards. Right. What are the hunting stages, and how can you use the hunting? How can you? What's the importance of the PLP in the hunting stages? Now, the hunting stages are 3. First of all, you're going to mark the opening time, and you're going to mark a potential pre-open liquidity pool, which will mark the bottom. Next up, that's stage 1. Stage 2 is you wait for a reaction to form off of the pre-open liquidity pool. As you can see right now, focus on the chart. Opening time, it trades down into the pre-open liquidity pool plus the model number 1, and then it produces a swing point. At this stage, you can put the stop loss as the swing lows low. The entry is now, and the target is that other pre-open liquidity pool up there, right? So you're trying to take liquidity basically from one pre-open liquidity pool, from one PLP to the other pre-open liquidity pool. And that is precisely what happened, right? With that fake retracement all the way down to sucker in everyone to thinking, it's not going to happen. But all it was a dump to stop out the early bulls and rally further into that other opposing pre-open liquidity pool. And this is timed ranges, right? That's stage 3. Daily rolls. This is when it comes to the weekly candle. And before we go into this one, again, I want you to really rewatch this part, especially at least 10 times, which is the PLP and the hunting stages. These are very, very crucial. The way I explained it, every single word, every tone of voice, every change in the tone of my voice, every letter is deliberate. Right? These are the hunting stages. These are the stages you'll go through every single time you place a trade. And this can be any time frame. This can be a weekly candle, a daily candle, a 4-hour candle, right? Stage 1 is mark the landscape, mark a potential pre-open liquidity pool, which you're going to mark at the bottom. And then you wait for a reaction at your marked key level, and then you watch price rally into outer space, right? Now, the daily rolls of each day of the week. Monday is usually going to be accumulation, right? So up really fast and down real fast. Tuesday is going to be manipulation. And these are the official rolls of each day. If a roll switches, then you're going to have to learn to adapt and switch the rolls of the rest. And that's where critical thinking comes in mind. In CU, all of you who've joined, and those who will join later, right? You have to try and acquire the skill of critical thinking. Otherwise, this is all a waste of time, and it's going to be, most of you are probably going to fail miserably a lot. And the few of you who actually drag themselves back up and try again and again and again, regardless of the failure, those will prevail, right? And it'll be especially beneficial for those who have been part of previous private groups. But this is designed for everyone, right? So no matter what your level is, this is the official CRT guide. Moving forward, just see you. Monday, accumulation. Tuesday, manipulation. Wednesday, distribution. Thursday, slowing down of continuation. And then Friday usually caps the weekly range. Now, Thursday, Friday, both usually will cap the weekly range. And let's look at what that looks like in a candle. Right, and why does this matter? Why do these daily rolls matter? They matter if you are trading the weekly candle, because you have to know what to do on each day. If you know Monday is going to be accumulation, most likely, or that's its role, then you are less trigger happy on Monday. On Tuesday, you start looking for a setup, a high of the week, to potentially form. And I can just hear some of you saying, yeah, but sometimes it forms on Tuesday, on Wednesday or Monday. Yes, it does. That's why I mentioned 2 seconds ago that these are the officially designated roles to each day. If one of them switches up, then you have to go and adapt the rest to the switch up. All right, that's very important. But this is the basic and the most common route. Tuesday, you start looking for a setup potentially. Wednesday, you look for an OTE to happen to continue the top of Tuesday. Right, so Wednesday is usually a very easy day to trade. Thursday is a slowing down of continuation, but still you can trade in the direction of whatever happened in the week previously. Friday caps the weekly range, so sometimes it offers you. They offer you on Thursday and Friday a trade that caps the weekly range. And this is not me, this is not some some garbage. This is the market maker's schedule. This is how the market maker plays with the emotions of the masses to make as much money as possible. All right. Daily rolls within the week. Now look at the weekly open marked in the solid vertical line. That's Monday, and then you have Tuesday, and then Wednesday is a nice OTE continuation, and then Thursday, and in this case, Friday dumped with no mercy, right? So I really want you to focus on mainly on Monday, Tuesday, Wednesday, and the idea, and write this down, the idea that Monday, Tuesday, Wednesday form the high or low of the week, and Thursday, Friday form they cap the opposing end of the range. Right, that's the idea I'm trying to put in your mind right now.